what I would like to speak about is, despite the financing options being there, what is kind of constraining the growth in localization? More importantly, what is kind of acting as a stumbling block for ineffective usage of this financing for the intended purpose? So in this presentation, I will be speaking about three aspects. The role of a credit rating in the entire process of financing. So financing on a standalone basis, one can easily say, yes, financing is there and growth happens. Actually, it has to be seen on three parameters. Availability of adequate financing. Say you have a project, let's say we are talking about a community project, let's say development of a particular park, and you need to know what would be the project cost. Let's assume that it's going to be, say, somewhere around 10 crores in a bigger place and with a bigger cost and with a bigger facilities. And you need to go and approach a bank for the purpose of funding. You need to know at the first place what is adequate level of funding or adequate level of financing for this particular project. In most of the scenarios, the fact that the funding is not made available to the extent of requirement is a key stumbling block. One. Second is the timing of finance. Ma'am talked about the necessity of the time. Even in finance, if you don't get the finance at the right period of time, you are going to incur more cost. The project will have an overrun, cost overrun. A time overrun will result in a significant increase in the overall obligations on the interest cost. Your payback gets deferred. Your IRR, or the return on effective capital, is going to be prolonged. So there is all cost to it. So we spoke about adequacy of financing. We spoke about timeliness of financing, and the third aspect is the cost of financing. Any loan that you go for a bank, it obviously comes at a cost. You call it an 8% rate of interest, or a 9%, even a single percentage, 1% change in the cost of funds can have a significant impact. So this is where the role of a credit rating agency, or the role of credit ratings as a concept, plays a big role. Not only in determining from a banker's point of view whether the loan can be sanctioned, loan has to be given, if so, to what extent and at what cost. This is more from a corporate standpoint. From an individual standpoint, you would all heard about this CIBIL. So you are going to apply for a home loan. The first thing CIBIL looks into your credit history, and they talk about your past delays in the credit card payments, etc., putting a demerit point, and it has an impact on your eligibility and also on the rate of interest. The same concept applies in credit ratings. So for the next 10 minutes, you would be donning the hat of the banker, lender, in terms of assessing how a credit must be evaluated, and this will help you in knowing that how a business will have to be analyzed, and how, as a credit rating agency, we do evaluating companies and assigning credit ratings. To start with, the credit ratings. What is a credit rating? I spoke about a CIBIL equivalent. If I have to talk about corporates, as a rating agency, what we do is, let's say a company has taken a loan, and banks have a bigger skin in the game because they have given the loans and they have the risk of collecting the repayments in a timely manner. So rating agencies are independent agencies which look into the credit profile of the entire company, not only the numbers, financial numbers. The financial numbers are only a derivative of something. What is that something? How we will be analyzing is what is more critical. So it is a rating is basically an expression by a rating agency by way of telling that yes, you can give a loan to this company, or you don't need to give a loan to this company, and it is expressed in certain form of symbols. As I say, you are going to don the role of a hat, don the hat of the a banker. You are reporting to a sanctioning authority, like your bank manager. Your sanctioning power is somewhere, say, around 10 crores. The banker, because of your designation, etc., you have an approving power of up to say 10 odd crores. And you have multiple proposals. You have a proposal coming in from a manufacturing company saying that I need 10 crore for working capital. You have a requirement for a working capital from a jewelry company. You have a requirement for a working capital from a real estate company. You also have a requirement coming in from a company which says that I want to do community promotion. More importantly, develop the community. And you as a banker will have to take a call. Where should I fund? One of the reasons why the public funding has not taken a bigger shape as compared to most of the matured markets is the inadequacy of funding or the lack of funding or the evaluation not being done in the way it should have been done. Most of the times, the banks are constrained to extend credit to the safer sector. A manufacturing company, you know that my repayments will come. A jewelry company or a real estate company, although a lot of cash is inherently high in such businesses, still the fact that inherent product, say jewelry or a real estate, has an appreciation by default. What is in it for me that I have to fund to a project which is going to go for localization? So from the mindset standpoint itself, there has been a constraining factor that is why traditional financing for the sector has always been coming from, say, someone like HUDCO or the major LICs or even the bigger financial institutions who have funded them. But the other aspects of financiers, they have kind of shied away. So what we will try to see is that from a banker standpoint, how should one look at it? Before getting into that, I will just quickly run you through in terms of the expression of these ratings. So these ratings are linked to the level of extent of credit that has been given to the company and at what cost. So the rating scale is something like starting from a AAA running all the way down to D. The higher the rating, better it is. I'll quickly explain how this rating works in terms of pricing. The same 20 crore example I will give as a banker. For the money that you have extended, you have to create a provision in your books. X proportion of that money, you have to create a provision. Let's assume that number is say 100 crore is your total value of loan. A 9% is something, a provision that every bank will have to provide in their profit and loss account, that is a charge. However, if that loan is being given to a company which has a very good credit rating, they need to provide for only 20% of 9%, that is like 1.8%, which means it is a saving of over 7% for the bank, which gets passed on to the customer. That is why higher the credit ratings, the companies will pay lower rate of interest. Vice versa, lower the credit rating, they are obligated to pay more rate of interest. Specifically in say projects around municipalities and similar public finance related things, the cost of funds are inherently high because the risks in such businesses are perceived to be relatively high. So how would you analyze a company? How would you analyze a particular project? It's very important that most of the times we analyze a company, an annual report just based on numbers. You look, the revenues are increasing by 20%, the EBITDAs are going up by say 10%. My debt is at a particular level. That is only 20% of the analysis. Most of the time the analysis has to start from as a top-down approach. You need to know the industry in which that company is operating. You need to know what is the nature of business that they are kind of doing. You need to know the risks around operating a business. While the topic is more from a localization and public finance standpoint, since you would be preparing yourself for your campus interviews for your finance jobs, I would want to give some example of a live company and then move on. I'll take an example of a jewelry company, for example. From a listed company standpoint, most of the time we see that Titan being the largest company. The company has over 2.5 lakh crore market cap, operates with over 400 odd stores. You would see that their top line is somewhere around 45,000 odd crores and an EBITDA margin of over 10 odd %. I'm also looking at a company, a south-based jewelry company with only 50-60 showrooms with a similar top line, but with only 4.5% EBITDA margin. Still, I would say that the credit profile of both these companies are fairly comparable. The reason is that one needs to know what are the regional dynamics in each of these businesses and how would one deep dive in terms of into analyzing these companies. So first of all, at an industry level, one needs to know what are the inherent risks in this business, and within the business, who are the competitors, what are the pricing related challenges, what are the regulatory related challenges, all those one will have to look at. And finally, how these all translates to financials. So this we analyze, this we call it as a business rating, and from there we also look into the promoter profile, which is very, very important. However good the business may be, if the attitude of the promoters have to be like, I buy business today, after 3-4 years I will be selling it to another entity, it doesn't help. So a rating is basically an analysis of combination of multiple factors, sum of parts, which includes financials, business and this thing. The same logic if we have to talk about financing for the local development. In the earlier presentation we saw about what are the general options or avenues of funding. We talked about the public funding. Typically for a government, the public funds are coming from your property taxes, which is the main source of revenues. The grants, capital grants, for example, the government will say invest in this state, I will provide a capital grant or incentive. That is a key revenue for funding the projects. And for private, if we talk about, there are multiple avenues, including your CSR contributions, etc., if it is applied in a rightful manner. We also talk about the cooperatives. We spoke about, Mr. Karthik spoke about Lidget Puppet. I would like to talk about the dairy cooperative society. I don't know how much you are aware about how a cooperative society actually works for dairy. This is a very good example for financing for the local development. Here, it's a very integrated structure. Amul is the visionary in this particular segment, which has been followed by multiple other states. Let's talk about, say, state of Tamil Nadu. So how it operates is, there are 3-tier structure. You have a primary cooperative society, which will collect milk from farmers. So the farming community is supported by way of assured remuneration for their milk that they go and feed there. From there, the district cooperatives pick, and from there it goes to the federation. AVIN is the federation. So finally, AVIN, what it does, it may not have its own capacities, processing capacities on its own, but having through the structure, they ensure that the farmer is actually reached out, till the last farmer is reached out, and enough financing happens within the entire structure towards supporting this entire thing.
Sir, I might take 2 more minutes.
Yeah. And finally, when we talk about inclusive growth, it has to be including that the resources that is available. This is where the farmers come into picture. I'll give one very simple example, but I will possibly rush through on my PPT with regard to going deep down on the analysis. Here we are talking about analyzing the ULBs. ULBs is basically your municipalities where you have a project that you have to deploy, and for which you raise municipal bonds or other funding options. So typically what happens is that you have to analyze each of these parameters to see whether, as a banker, if all these checkpoints are ticked. The first checkpoint is basically the level of interaction or the relationship with the government. What kind of relationship the government has with that respective municipality. Better the relationship, the scoring is, and if the relationship or the rule-based transfers has to happen in an unmeaningful manner, it's obviously penalized. What is the viability of that particular municipality? The municipalities closer to the state capital will have better prospects than one in non-remote place, in a remote place. Third thing, you may fund it, but are they applying it for the intended use? Are they efficient enough to deploy that money for the intended use? So now we'll have to look at multiple parameters in terms of efficiency parameters. This applies even in the corporate world, that whether the company is efficient enough and it is reflected in your EBITDA margins. Finally, how this all translates to financial strength, financials, whether this is reflecting in better profitability, good liquidity, and adequate debt coverage metrics. And finally, from a future cash flow projections, what are the projects that are identified and whether enough funds are being made use. And last but not the least, the risks involved in this public finance is that some are using accrual based off accounting, some are still following the cash mode of accounting, and more importantly, the level of disclosures are not significant enough to take that comfort. The bond market in India has not developed yet compared to the global markets, where even at a BBB rating, funds are made available. Here, ratings above AA only get that kind of a funding. So this is where the innovative fund financing, the role of World Bank, IDCs, help in kind of addressing these issues in supporting the kind of financing. This is my last slide, where we speak about the entire assessment of these parameters into multiple buckets and how the rating is arrived at. And because of the fact that municipalities are associated to the states, the state ranking is also kind of adjusted and kind of get elevated. So in a nutshell, financing as a concept need not be looked in standardization, it has to be looked at the adequacy, timeliness, and at what cost. So funding options are available, but still there is a lot of hesitation or cautious stance taken by the traditional lenders. For this to change, the rule of thumb is that the basic disclosure levels, basic hygiene factors around systems, manpower, and the qualitative aspects will have to be strengthened so that the banking community or the lending community is confident of supporting this particular sector. Thank you. Thanks for the opportunity.
Thank you, Mr. Srikumar, for throwing light on